Welcome back to Mirror's Signal podcast. I'm your host, Josh Holleran, and today we are joined by Andy Stinson. Andy is a driving instructor. He's also a mortgage advisor, and today's episode is going to be about mortgages. Whether you're looking at getting a mortgage for the first time or you have a remortgage coming up in the not too distant future, this episode might just answer some of your questions. We also talk about managing your accounts, and towards the end of the episode, we discuss a little on pensions. Now, please be aware this episode is not offering financial advice, and you should always do your own research. If you're enjoying the content, make sure that you give it a like. You can also leave a comment. There will be a new episode going out every Sunday, so make sure you hit the subscribe button, turn on your notifications so that you don't miss any episodes. Now let's move on with the episode. I hope you all enjoy it. Andy, how are you doing?
I'm good, thank you. You?
Yeah, I'm not too bad, thank you. It's a different one tonight. I'm looking forward to it. So before we delve into where we're going, would you like to introduce yourself a little bit for the viewers and listeners so they know a little bit about you?
Yeah, so some of you may have seen on me on various Facebook groups, whatever. So I'm Andy Stinson. I'm a ADI, been qualified for about 18 months, I think it is. So still fairly new to driving instructing, but I'm also a fully qualified mortgage and protection advisor. So kind of do both part-time, depending on where it takes me. So I just thought, obviously, coming on here, could use my experience of being self-employed, being a driving instructor, but also obviously my experience with mortgages and protection and all that stuff.
So it's the mortgages I'd like to talk a little bit about. I've got a remortgage coming up, so
Yeah,
we've got that. But mainly it's something a little bit different. A lot of the content I've put out so far has been around being a driving instructor and the qualification process, CPD, how we can develop as instructors, and very much around that. Whereas this, I think, is nicely linked. You're a driving instructor, but a mortgage
hmm
advisor. And it can sometimes be a bit of a challenge for self-employed trying to figure out mortgages and getting good information. And then as well, people understanding a sector and an industry, like being
yeah,
driving instructors.
yeah,
I don't know what it's like for mortgages. I've not remortgaged yet as a driving instructor, but I
yeah,
know income protection insurance was a
yeah,
little bit of a challenge due to the
yeah,
nature of the job. I assume
yeah,
we're slightly higher risk being in the
yeah,
car all day and on the
yeah, yeah.
road. But what's led you to balance being a driving instructor and a mortgage advisor?
So, I mean, the driving instructor part was about getting a bit more work-life balance. So before that, I was employed in, quite a pressured job, which meant I was working long hours. So doing the driving instructor gave me the flexibility. Mortgages, it's something I've always I am quite a numbers person, quite an analytical person, and I do like helping people. That goes with driving instructor and mortgage advising. So yeah, it just to me, even though this seemed completely different, it is all about helping people to achieve something, whether that's being buying a home or remortgaging or whatever, or getting the driving license. And the good thing with both of them, because they're both self-employed roles, so I can kind of decide when I work, how much I work, when I don't want to work. So it just kind of works really well together, and obviously with mortgages, a lot of people, there's a lot of people that don't, I suppose, but a lot of people work 9 to 5. So I tend to do driving lessons during the day. And then in the evenings, that's when I'm on the phone giving advice for mortgages and whatever. So yeah, they just kind of work quite well together, to be fair.
Nice. So the helping people is certainly something I'd not seen that from the mortgage point of view. For me, when I
Yeah.
got my mortgage a few
Okay.
years back, it was I shopped around found someone, I guess, yeah, he was similar. He had passion for it. He sounded that
Yeah.
way.
Yeah.
Maybe something to do with how much I ended up paying him as well.
Yeah.
But it's for a lot of people quite a big step taking
Yeah.
on a mortgage. I was fortunate when I got it. I was in the military, so I had a steady income.
Yeah.
And as far as anyone was concerned, a secure job for the
Yeah.
next 15 to 20 years. I've since left that secure job to go
Yeah.
self-employed and
Yeah.
take a risk.
Yeah.
Something that interested me when we was on the phone was around the information you shared with me about getting a mortgage as self-employed. I was under the impression that I needed 2 years, and that's been a bit of a worry for me. But does that come down to specific lenders? What tends to be, as a self-employed person, what should I be looking to have
Yeah.
to then approach someone to get a mortgage to buy a
Okay.
house?
So yeah, the 2 years is an ideal situation, and each lender has a criteria. So you'll find maybe, one lender will want 2 years of accounts. There's no ifs, no buts, whereas another lender would be happy with one. Now, the lenders that potentially would be happy with one, maybe a little bit more expensive because it's a bit more of a risk for them. But there are lenders out there. And funnily enough, I have been working with a client who is a driving instructor. They've only got 1 year's accounts. The other complex thing is that they take most of their payments as cash, so just cash in the car, and then go and, buy the food shopping and whatever. So a lot of their income never actually hits their bank account, which can be a challenge. So one of the things that I kind of, because I just assume all my driving instructor payments, I take either bank transfer or through the app that I use, like the booking app that I use. So it all goes into my business account, and then it's there, and then obviously it's linked to accounting software, so then I can balance everything. So yeah, one bit of advice that I could give is, even if you do prefer to take cash payments, and I know a lot of people do like to take cash payments, if you can get that deposited into your account, just so then for a lender they can see that income in your bank rather than, you getting X amount of money from your lessons for the day, then you go to the supermarket, buy your week's shop. None of that's then going to be recorded like on a paper trail. So that would be one bit of advice I would give. But yeah, in terms of your accounts, like I say, there are lenders out there that will consider 1 year. If you're in a position like you're in, where you're looking for a remortgage and you're not quite at the 1 year's accounts yet, you can do what's called a product transfer. So it's like a remortgage, but it's with the same lender. So if your current lender is, say, Barclays, then you stay with Barclays. They don't do any affordability checks, they don't do any credit checks. It is just literally going on, clicking the new product that you want, and that's pretty much it. So they wouldn't even need to know necessarily that obviously your income may have changed, because they're not looking at that. They're still basing their decision on the last time that you applied. Obviously, for you, you need to still make sure that it's affordable. So if your income has dropped massively, maybe it's not affordable, and maybe that's something that you should then look at. But as a general rule, if it was affordable, then they should be happy that it is affordable now.
That's interesting with the accounts and taking pash taking
Pash,
cash
yeah,
cash payments. So I very rarely take cash payments, and I
yeah,
think there's always been that in the back of my mind. I mean, I'm fully self-employed now and have been for almost a year, but
yeah,
I was a driving instructor for near 18 months before that. So
yeah,
I have given part-time accounts
yeah,
to my accountant, they've worked
Yeah.
their magic, charged me a fortune, and told me how much tax I owe.
Yeah.
So I do have some accounts from
Yeah.
previous years. And I think that's why I always took bank transfer,
Yeah.
was so that I could just evidence everything,
Yeah.
and it was easier to give it to my accountant. So I've
Yeah.
always done that. Very rarely take cash. But with the kind of financial knowledge that you've got, is there any advantage to using a business bank account over a current account? Is that something that you wouldn't really
Um,
advise? What's your thoughts on that?
so it does make it easier because you're separating it. So I have got, and it's just like one of these online banks that I do all my business banking with, and then I've got like a high street bank that I do spending and my personal direct debits and stuff like that. And for me, it just keeps it separate because obviously if you were to send me your bank statements when you were looking for a mortgage, obviously as a mortgage advisor, I've got to go through that just to see if there's anything there that's not been declared. So, there might be a loan that's not on your credit file because it's not gone through the traditional channels. So it could be you borrowed 10 grand from your uncle or something like that, and you're paying them back £200 a month. So if I saw anything like that, then obviously then I would then ask questions. So what's this money for? Where's this money going, or where's this money coming in? And obviously with a business, certainly for my driving instructor, there's obviously various income from different students, different methods. So, like I say, some are bank transfers, some are online payments, and then there's different expenses. So, fuel, and I pay franchise fees. But if you're not in a franchise, it'd be like car insurance and all that kind of stuff. Then I pay for a website. I'm trying to think what I pay for, but yeah, all these different expenses. Now, if that was all in my personal account, because obviously all those expenses will come off my turnover to get my net profit. So actually, what I then declare to the taxman is everything after that. So then, if I was looking at it as a mortgage advisor and I've got, Tesco, Asda, whatever, and then all of a sudden there's something else. I'm like, okay, is that business? Is that personal? Is that already been taken off your income? I'm not saying you've got to. It just makes it easier if you've got two separate bank accounts. One for business, one for personal. Certainly, if you're preparing for a mortgage, it makes it a hell of a lot easier for a mortgage advisor. But the reason why we have to go through it in such detail is because those questions that we ask you are likely the questions that the lender's going to ask us. So, what we don't want is this lender to say, "Oh, what's this £1,000 that keeps getting transferred out every month?" And if we're like, "Oh, I don't know," we look like we've not studied the case properly to make sure that everything's covered. So, yeah, if it was me, and you were preparing for a mortgage or even a remortgage, try and keep it separate.
That's some good advice, and I find it so much easier having a business account and a current account.
Yeah.
Does it make any difference if it's a specific business account? I mean, I have a couple of personal accounts and a business account, but it could
No.
just be another personal account that all your business transactions go
Yeah.
through. So income,
Yeah.
outgoing, and then transfer to a different account for your kind of personal or wages, whatever you're going to label it as.
Yeah.
It doesn't matter if it's a specific business account,
No,
just keep them separate.
it doesn't have to be labeled as a business account. Obviously, if you're a sole trader, you can use personal banking. If you've gone down the line of a limited company, don't quote me on it, but I'm pretty sure then you probably would have to have a business bank account. But I don't think there's many driving instructors that are limited companies. There probably are some, but that would maybe be the ones that have branched out into other things like training and all that kind of stuff. And with a limited company, if there are any out there, it's very, very similar. It's just obviously it's not self-assessment. It's a full tax calculation that we'd need to see. So we need to see like full year accounts certified by an accountant. That's the main difference. And some people also, I had another client, they got their own limited company, but they were paying themselves through PAYE, which is fine, nothing wrong with that. However, what they didn't realize is if you own more than 25% share in that business, you're still classed as self-employed, whether you're paying yourself through PAYE or taking shares or dividends or whatever. So even though you've got pay slips, we still need the business accounts, because what somebody could do if they really wanted to is, they could say, oh yeah, I'm paying myself £100,000 a year, but actually when you look at the accounts, that's not affordable for the business. So that's why if you are a limited company, the lender would want to see both pay slips and accounts.
That's interesting. I assumed a limited company would be completely separate. I mean, I don't know much about them, and I have no intentions of learning anytime soon. I'm happy being a sole trader.
Yeah.
And I know my
Keep it
accountant
simple.
charges a lot more for a limited company.
Yeah, keep it simple.
So that's interesting as well, then, that it doesn't have to be a business account, but keeping it separate is gonna help.
Just makes it
in the long
easier.
run if you're looking
Yeah.
to get on the property ladder. And there was something that I wasn't expecting when I went through to get my mortgage, and I'm not sure if it's still the same now, but at the time I had a couple of credit cards.
Yeah.
And I was told part of, I can't remember whether it was a mortgage in principle or a decision in principle, something like that.
Yeah.
So I'd not had the funds, but they said, yeah, well, we can lend you the money. But part of that was this credit card needs to be paid off.
Yeah.
So I'm like, I've got to get rid of that. Is that something that would still be the case? They look at the debt, assess affordability, and maybe advise you need to clear some of this debt as part of the mortgage? Or was I just what's the score with that?
It's still common. So yes, mortgage in principle, decision in principle, agreement in principle. Different lenders call it a different thing, but it all means the same thing. So in terms of what that is, that's just basically we give the lender the information that we've got. So, your current credit commitments, your income, your outgoings, all that kind of stuff. Most of them will then do like a soft credit search on you. So it doesn't leave a footprint. And based on that information, they then say, okay, provisionally, we would accept or not. But then the next step is then obviously the full mortgage application, where everything gets drilled down and really gone into detail by an actual person rather than a computer. So they're called underwriters, if you've not heard of those before. But yes, the affordability thing. So it's surprising. So I had a client recently that we were trying to get her a mortgage, and with the lender, it just kept coming back that she wasn't quite there in terms of their affordability calculator. And all it came down to is she had a very, very small outstanding loan, but she was paying around £150 a month to that. There wasn't a massive amount outstanding, to be fair, but with a loan, they tend to go on the monthly payment rather than the actual outstanding amount. Obviously, the outstanding amount will affect your credit score, but they're looking at the monthly payment. So what they said is, I mean, a lender can't stipulate that you must pay this off and we will give you a mortgage. They can't do that. But what your advisor can do is work out what your affordability would be without that commitment. So whether it be a credit card or a loan. And obviously by paying that loan off, it then got her past the post in terms of affordability to where she needed to be. So, by paying that extra bit at the beginning now means that she could afford to get that mortgage. So yeah, it's still a common thing. And because of the the financial crash, whatever you want to call it, from 2008, where before then, literally you used to just go to the bank and say, "Oh, can I have 200,000?" And they'll say, "Oh, have you got a job?" "Yeah, okay, here's the money." Obviously now, because the stuff hit the fan basically back then, they are very, very strict now. They're very thorough with their assessment, and if you don't meet affordability by £100, you don't meet affordability. There's no kind of like, "Oh, well, okay, yeah, maybe you could earn a little bit more over the next year and you'll be fine." If you don't get meet it now, then you're not going to get it. So the first step really is to see, an affordability calculator is available to anybody. You can go on any lender's website and they'll have a mortgage calculator, affordability calculator. Put in your income, basic outgoings, how many applicants there are, how many dependents, because having dependents obviously brings down your affordability. And it'll tell you roughly, it is very, very roughly, how much you can afford. Obviously, when you go to a mortgage advisor, we'll go into it in a lot more detail to find, which lender's going to give you that mortgage, because it can be quite a big difference. So, a typical case, I could have a range with different lenders from, say, one at the bottom would say, "Yeah, we would borrow £20,000 to this client," and then the top one would say, "We'd borrow 320,000 to this client." And I mean, it must be some kind of wizardry how they work it out, how it can be so different, but that's what it is. And that's the good thing with using a broker, is that you might have gone to that lender that only said £20,000 and done their affordability calculator, and it's come back, "We'll borrow you £20,000. So then you're just going to think, "Oh, well, I can't get a mortgage then." But actually, you can. You've just gone to the wrong lender. And each lender has got their own kind of speciality, which again, being having the experience of a broker, we know if you say something like, "Oh, I've got a CCJ," straight away, if someone says to me, "I've got a CCJ," I'm already thinking like, "Okay, this lender, this lender, this lender." Um, whereas you might just go, "Oh, let's go to Lloyd's or TSB or whoever," and they might decline it. And then you might just think, "Well, I can't get a mortgage then." But again, you can. It's just that you've gone to the wrong lender. So yeah, the benefits of coming to us, any of us, is that we can quite quickly narrow it down to maybe two or three lenders that we think would potentially borrow the money to you. Then we can go further, decision in principle, agreement in principle, whatever you want to call it. And that just kind of ratifies what we thought. So then they'll say, "Yeah, yeah, we can see there's a CCJ, but we're happy with that." Again, these that specialize, the higher the risk to the lender, the more expensive it's going to be to you. So if you have got CCJs, you're not going to get any of these rates that's being published at the minute on the news, and that way you see, "Oh, there's a lender offering 4.29% or something like that." You're not going to get that rate with a CCJ or a default, or highly unlikely, should I say. You're probably looking at more 6, maybe even 7, maybe even above, depending on your situation. But at the end of the day, it still gets you on the ladder. You only need to be tied in maybe for 2 years or 5 years, and then hopefully by then you're in a better situation, and then you can look at remortgaging to a better product. But we've all got to start somewhere, and I always say to people, it's better to pay your own mortgage than your landlord's. So if you are renting, and you think, "Well, I don't really want to be paying a little bit more on a mortgage than my rent," well, it's your mortgage that you're paying, not somebody else's. So that's my opinion. Obviously, there are people out there that are devout renters, and they think a mortgage is like a death tax. So yes. Back to the original point, in terms of affordability, something as small as an outstanding credit card could mean the difference between getting your mortgage or not. But again, your advisor would tell you that, clear that credit card, then we can look at it. So I always say to my clients, I'm not going to say to you, unless there is something, there are a couple of things where I just can't help you. So one being, if you're in bankruptcy, can't help you at all with a mortgage. And the other one is in an IVA. Again, it's not as definite as bankruptcy, but you really, really, really would struggle to get a mortgage in an IVA. And there's a lot of obviously legislation around it. You have to get the IVA supervisor permission if you want to borrow more than £500. And to be honest with you, I can't even. So there's one lender in mind. I'm not going to mention who it is, but they're very, very expensive. We're talking like 9% interest rate plus, but they pretty much, will give a mortgage to virtually no matter how bad your credit history is, as long as you've got some kind of deposit, they probably will give you a mortgage. But again, you're paying for that. But with them, even with them, IVA, pretty sure they don't, and definitely not bankruptcy. So I always say to clients, if now's not the time, I'll be honest with you, and I'll say to you, okay, this is what you need to do. Go away, work on getting that credit card cleared in the next 2 months, 3 months, whatever, and then I'll get in contact, or you contact me if you've paid it off sooner, and then we'll go again. There's no. I don't think anybody is unmortgageable, if that's a word.
It is now.
It is now. It's just sometimes it's not the right time for that person.
So there's some things that you can do to help yourself, like you said there, with potentially credit cards, things like that. You mentioned about the lender will lend with some kind of deposit, and they'll lend to pretty much anyone.
Yeah.
What are we looking at these days for a deposit? Are you still looking at 10%? Is it higher to get the better interest rates? For a first-time buyer, what should they be looking for a deposit?
So again, you will see maybe some people, and I've done it myself on my own marketing. There is a product with a lender where you can potentially get a 100% mortgage. What they do is so this is for renters though. So they base your affordability on how much rent you've been paying. Because there's that old argument that if you're paying £1,000 in rent a month, then surely you can afford £800 on a mortgage. But a lot of lenders will still say, no, you can't. But there is one lender that will look at it and will base your affordability on that, or your salary affordability, whichever is lower. So if you're on a low income but paying high rent, that's not going to work for you. But if you're on a higher income and paying, highish rent, then potentially that's a product. So potentially no deposit, but realistically, very minimum of 5% deposit. So you don't need 10%. But again, the more deposit you have, the less risk you are to the lender. So that means the product's going to be cheaper. So the products with a 5% deposit, they're not the products that's under 5%. You're probably looking at, and this is just, it's not saying for definite this is what the interest rate is, but you'd be looking at like maybe 6-7%, something like that, for a 5% deposit. To get the best rates, you're looking at, and it's for most it's unrealistic, but you're looking at 40% deposit. So if you've got 40% deposit, that could be just the equity in the property. It could be inheritance. It can be gifted. So if a family member gifts you a lump sum of money, that can be accepted for a lot of lenders. But yeah, to get those real good, I say good, I mean, 2 years ago, 4% would have been shocking. But now, anything between 4 and 5 is good. Yeah, but you are looking at 60% loan to value, so a 40% deposit for those products.
That's a big chunk of money with
It is a
the
big chunk of money.
rate of house prices at the minute.
Yes.
Because they're shooting up. For me, it's great because I've managed to
Yeah,
get on the property
yeah,
ladder.
yeah,
But for people trying now, I've got friends that are trying to buy, and it's a challenge
yeah,
because the house prices are going up, so they're needing a bigger deposit, and then
yeah,
the interest rates are going up. So the
yeah,
mortgage is going to be ridiculous
yeah,
when we do buy.
yeah,
And I think as well, we'll put a note in now that we're filming this the back end of 2023. So
yeah,
hopefully we can look back at this in say 2025
yeah,
when we're back at
yeah,
1.2% for 10
yeah,
years.
yeah. I mean, just on that point though, while we're talking about interest rates, because again, I have a lot of clients that will say to me, "Oh, do you know what? I'm going to wait till the interest rates go back down." If you look, and this is not just like a sales pitch or anything, if you look historically, the the 1% and 2% were the anomaly. The 4, 5, 6% is the normal. So actually, when the market crashed in 2008, they lowered the interest rates to try and get people spending again. Um, and then obviously everybody spent and spent and spent and spent, and then inflation's gone up. So now it's like, oh, we need people to stop spending. And the way to control spending, one of the ways, is with the interest rate. So up the interest rate, inflation comes down. So that's where we're at the minute. So if you are sitting there watching this thinking, yeah, I'll leave it till next year until, maybe we're down back down to 2%. I'm not saying it definitely won't be, but I highly doubt it. I don't think we will ever see 1 and 2% again, if I'm honest, unless, something bad happens. I mean, we've got general election next year. Who knows what will happen depending on the outcome of that. But yeah, and the other thing is when you think about interest rates and house prices. So when the interest rate goes up, house prices start to go down. When interest rates go down, house prices start to go up. So one way or another, you're still going to pay. It's whether you're paying the bank the extra money or whether you're paying the seller of the property the extra money. But either way, you will pay. My house probably in the last years maybe gone down in value by, I don't know, maybe 5%, something like that. So actually, if somebody was coming to buy my house, yeah, they might have to pay an extra £200 on the mortgage or £300 on the mortgage than they would have to do 2 years ago. But potentially they're saving, 20 grand on the purchase price. So it swings and roundabouts really. And there's an old saying that rather than wait to buy, you buy and then wait, because one of the most secure investments is property. It never. Well, I'm sure someone might say it has done in the past, but over a number of years, if you look at it as a long-term investment, you're almost guaranteed to make money on it. Now, that's not a guarantee, but almost guarantee to make money on it. And statistically, house prices double every 10 years. So if you buy a house today for £200,000, in 10 years' time, potentially that house could be worth 400. What other investment's going to double um, in 10 years? I mean, there probably are some, but
Bitcoin.
Bitcoin, yeah. In fact, funnily enough, I was on a Facebook because, like with driving instructors, how we have Facebook groups and all that kind of stuff. Obviously, there's also ones for mortgage brokers, and someone was asking there. They got a client that their deposit is coming from the sale of Bitcoin, and
Huh.
they were asking which lenders would go for it. And I was thinking, I mean, we've got to get with the times. And I've never personally invested in cryptocurrency, but I know people that have made quite a bit of money on Bitcoin, and one person in particular, he was there right at the beginning, but then when it started to go up, and his original £20 investment was now worth 10 grand, he cashed it in, but probably now it'd be worth like 4 million or something like that. So yeah, crypto, who knows? But yes, apparently you can use sale of crypto for deposit.
Good luck with the tax man on that, or woman,
Yeah,
whoever's
yeah, yeah,
collecting.
yeah, yeah,
Yeah, I do find that interesting with the property when you were saying about an average of, sorry, the property on average doubles every
Yeah,
10 years,
yeah,
because you can now see how it becomes almost unaffordable for
yeah,
some people
exactly. Yeah.
because wages don't double every 10
No,
years.
no.
And the interest rates, although yes, before 2008 was quite high,
Yeah,
house prices were relatively cheaper
yeah,
for the salary. But we can discuss economics and other things. And
yeah.
I'm not qualified to talk about that. I just listen to other people and like to understand a little bit. But back to getting onto the property ladder, we've got that for the self-employed, keeping accounts separate
Yeah,
is maybe one bit of advice that will put
yeah,
them in a good position. Managing debts potentially or looking to pay things off if you can. I
yeah,
expect seek advice about that rather than going ahead and
yeah.
sinking a
Double
load of
check.
money into debt.
Don't suddenly go, oh God, I've got to clear all my credit cards. You might not need to clear any of it. So check first before you start panicking. And like I say, your advisor will say to you, yeah, if you could clear that one, that's going to then give you an extra £20,000 on affordability. Um, so yeah, that's definitely another thing to consider.
What else can we do as self-employed to prepare for a mortgage? Are there other things you advise clients that are self-employed to do? Or if someone's at the stage where they want to buy, but they want to put themselves in the best position, what else can we do?
Obviously, it all comes out as a sole trader. It is all down to your profits, how much you declare to the tax man. So another thing is, it might sound obvious, but maybe it's not to some. Try and keep your expenses to a minimum. So if you're thinking about buying a house and then you're thinking, oh well, I'm ready for a new instructor car, so I'll put that on this year's account. If you know that you're going to then use those accounts for a mortgage, that's not really going to put because to a lender, yes, that's now an asset technically because you've got a physical asset for it, but they're just looking at that year's accounts, and your turnover could have been, £40,000, and then you bought a 20 grand car and put it all on that year's account. So now, even before any other expenses, suddenly you're down to 20 grand profit. That could affect it massively. So certainly don't make any big expenses. Don't go and get any new credit. So if you've already got like a credit card and you regularly, a lot of people will spend buy the shopping, or even driving instructors, I know a lot will use a credit card for the fuel and then at the end of the month just pay it all off. That's fine. Don't worry about things like that because it's not, even though a credit card, when you spend on it, it is technically new credit. It's called a revolving credit. Um, but what you don't want to do is go and get out a new hire purchase or something like that, a month before you're going to apply for a mortgage, because um, it's gonna it's gonna affect your credit score as a whole, but also it's another commitment. So that's going to bring, and like I said to you before, with my client, that £150 extra a month meant, if I remember rightly, it was about £50,000 difference on her mortgage affordability. So you might not think it's a lot, but the way the lenders calculate it, it can make a big difference, even just having like £150. So yeah, avoid that if you can, unless you're absolutely desperate for a car. Wait until after your mortgage is done, because buying a car on finance could potentially stop you getting a mortgage, but it's very, very rare that getting a mortgage would then stop you getting finance on a car. Do you know what I mean? So get your mortgage sorted first, then have a look at your affordability and see if you can then afford the car afterwards.
So, as a sole trader, if I was to go and get a car on finance for the business,
Yeah.
and run it through the business accounts.
Yeah.
To a mortgage lender, would that look the same as me buying myself a personal car or an outgoing for someone who's got a salary? Would it be seen different because it's a business cost? Or is it all the same debt because I'm a sole trader, everything's in my name anyway?
Yeah, because you're a sole trader, it is, even if it's used for business, it's still a personal credit commitment. And that's one of the main differences between limited company and sole trader. If you're a limited company, obviously, if you take out a loan in the business name, you are not liable personally for that debt. Whereas with a sole trader, it's all yours. There's no difference between saying, it's for driving instructor car than I just wanted a new car for myself. It's going to be tracked the same. They're going to use that on your affordability either way.
Would that be the same? I know we've got PCP and HP. I don't understand a lot, but I think one, the debt's attached to the individual, another, the debt's attached to the car. So if you default on payments, it's just the car that goes back. I could be completely off now.
Yeah.
Does that make a difference? Is that something?
Yeah, I mean, I know I'm the same as you. I don't fully understand the difference between hire purchase and PCP. I know obviously one of them, you have to then make a massive payment at the end to actually buy the car. But in terms of the debt, it's the same. It's still a debt, it's still a credit commitment, no matter what kind of structure it's on. Now, whether the the one where you've got a massive chunk to pay at the end, whether that would be counted towards, because technically you just give the car back and you don't owe any money. So whether that would be counted towards your affordability, I'd have to double check on like a case by case basis. But certainly the amount that you're paying each month will just go down as a credit commitment.
Okay, so any outgoing as a sole
Yes.
trader is
Yeah.
we got
Yeah.
there.
Yeah.
I like trying to find ways around it, but I think these mortgage providers are probably a little bit smarter than me.
Yes. Yeah.
Um, that's good. So you mentioned about protection as well. Do
Yeah.
you only do mortgages? Do you deal with income protection, or do you just advise people that they need it? How does that work? Do you need to have income protection as a
No,
sole trader to get a mortgage?
no. So you don't legally, the only insurance product that you have to have for a mortgage is buildings insurance for obvious reasons. Obviously, if the house burns down, the lender's got an interest in that property, so they need to make sure that they're going to get their money back. But apart from that, even contents, you don't have to have contents insurance. But again, if your house burnt down, you've then got nothing apart from, maybe enough money to rebuild the house. But in terms of income protection, life insurance, all those kind of protection policies, none of them you don't have to have. But what you need to think to yourself is you've put all this work into getting a house, and then surely you'd want to insure yourself to make sure you can keep that house should anything happen. So when I was employed, I'd been in that job for quite a long time, and I used to get something like 7 months full sick pay. I mean, you would have to be really ill to be off for longer than 7 months, but it happened. So it was never a massive concern for me, income protection, because I just knew that I'd have that money coming in. And then when I left there, and I was like, oh my God, what if I get ill? And what if whatever? I mean, just before I became self-employed, I had to have my gallbladder removed. I mean, luckily they managed to do it keyhole surgery, so it was like just a day case kind of thing. But had that gone wrong and I was self-employed and I ended up being off for 2 months or something, that's 2 months with zero income. Whereas if you take out income protection, and it could be, it all goes on your individual circumstances. They're going to look at family health history, your own health history, all that kind of stuff. But as a general rule, I mean, I've seen some policies that I've got for clients where it's maybe £25 a month where you're paying for that. And that would then pay out maybe £1,500 a month after a deferred period. So say if you set obviously the longer the deferred period is, the cheaper it is. So when you first get sick, say it's in January, if you've got a 2 month deferred period, the earliest it would then start to pay out is March, like beginning of March. And then they would pay out however much is insured. And then it's just a bit of income coming in. You don't have to, if you're at the minute earning 2,000, 3,000, but actually all your bills only equate to 1,500, then just go for the 1,500. So then you know that your your bills are covered. You might not be able to go out, but I suppose if you're ill, you probably wouldn't be anyway. So yeah, it was just kind of for me, that was my first priority. And I remember even speaking to the franchise team that I was with and like, what do I do? What if I'm ill? And they just basically said, you're just going to have to go and look for income protection, which, it can be quite hard to find, depending on your own situation. And obviously, the older you get, the more high risk you are, so the more expensive it gets. But again, the good thing with going to a broker is that we have access to multiple providers, so we can then compare. And one might come in at a ridiculous price. Like I had a quote the other week; it was like £150 a month, whereas another provider maybe is 25, £30 a month. And again, like I say, the good thing with going to a broker is that you kind of can review the whole market, but also look at the quality, not just the price. Because, with insurance, same with your car insurance, you could, potentially get a really cheap car insurance, but it doesn't cover if you lose your keys. It doesn't cover if this goes wrong, that goes wrong. It's the same with protection as well. Some of them, they might pay if you have to go and stay in hospital. They might pay for this, they might pay for that. Whereas others, it would just be, when you're on death's door, we'll give you some money.
Yeah, I'm not sure on the ins and outs of my policy. I've only recently taken it out,
Yeah,
and I didn't realize being a driving instructor that I'd be more in a high risk bracket.
yeah,
And then my sport and hobby put me in a high risk as well.
yeah,
So I kind of was very limited
yeah,
on where I could go. One,
yeah,
because of the job, two,
yeah,
because of my lifestyle. But the broker managed to shop around and find a reasonable one.
yeah,
But to make it somewhat affordable for me, that deferred period, I made it quite a long one.
yeah,
And I'm hoping that nothing too bad happens. And if it does, I've got enough to get by for, I think it was either 2 or 3 months,
yeah.
the
The most
deferred
common is
period.
like
I
two or
think
three
it
months,
was
but you
three
can go
months.
up to like a 12-month deferred period. Obviously, you just need to make sure whatever your deferred period is, make sure you've always got that money in savings. So if you're usually like going to £1,500 a month and you set your deferred period for 2 months, just try and make sure in savings you've got like 3 grand just in case. So you're not literally living on the edge if you were ill for 2 months.
Yeah, that was something that I had a chat with him about. He did say, how many months can you manage?
Yeah,
I might
about three
manage for a
days.
couple. Yeah. If I don't eat, I can manage a week.
Yeah.
But I did feel better once I'd got that set up.
Yeah.
I just put it off really, and I was like, I'll be all right. Nothing's going to happen to me.
Yeah.
And then you just think about it. It's like, well, I could break my leg falling down the
Yeah.
steps in the garden,
Exactly.
and we can't do our job with
With a broken
broken
leg.
limbs. We're not sat at a computer.
Exactly.
Well, you might be in the evening,
Yeah.
but
Yeah.
during the day, you're going to struggle
Yeah.
to do driving lessons with
Yeah.
a broken leg, broken arm.
And
So
how many
yeah,
times a
the
student nearly killed you?
that'll be why it's so expensive, won't it?
It is. Yeah.
So do you deal with that as well, or do you just have
Yeah. Yeah.
connections? Oh,
No,
you do.
so I can advise on income protection. I can advise on term assurance, so like life insurance, also general insurance. So obviously, because like I say, one of the Things that you do have to have in place when you get a mortgage is buildings insurance. So I can also search that. Obviously, a lot of people could do that themselves anyway. You just go and compare the market or whatever, and find it. But again, it's about knowing the quality of the product that you get in rather than just, oh, look at that, that's only £12 a month for this insurer rather than another insurer that's £25 a month. It's knowing what you get in, because it's going to be £12 for a reason, and the £25 one is going to be £25 for a reason. It could just be the way they calculate it, a bit like car insurance. Some car insurers are better for younger drivers than others, for example. But yeah, most of the time it's that, maybe there's some extras in there, but it's whether you need them extras. If it was giving you, like with car insurance, loss of keys, but you've got one of these new cars that doesn't even have a key, it's just an app on your phone, then you don't need key protection. So it's about knowing what you need and finding the product to cover your needs. So again, as a broker, we'd have that conversation. What are your needs? What, in an ideal world, what would you be looking for? And then we just try and meet all those needs the best we can. We can't always meet them completely, but then it's just about making that clear to the client that, you wanted to be covered for £1 million, but you wanted it to be less than £20 a month. Well, we've not been able to do that, but we've covered you for £200,000 for £20 a month, or you can pay more and be covered for £1 million. So just making it clear, to the client that we've done what we can, and this is what we've got.
Does that make a difference to your mortgage application if you have things like that in place? Income protection, no. Does that not come into account?
No.
Okay. Interesting.
The only other thing actually that we've not, and obviously this isn't my remit, I'm not a financial advisor. A lot of people get a little bit confused with mortgage advisors and financial advisors, but pension. So one of the things, if you're, depending on your age, because of house price and that, people tend to be first time buyers a lot older. Like, I bought my first property when I was 19, but I was very, very lucky. But I've got first time buyers that are in the 50s, maybe even 60s. And then they're looking for a mortgage into retirement. So one of the things that could affect it is your pension contributions. So if you are, say 40 or older, you want to make sure that you can evidence that as well if you're looking for a mortgage that's going to take you, say, past that. So they tend to, even though state age pension, I think it's like 68 at the minute, they tend to work on 70. I think they know that by the time people our age get to retirement, it's probably going to be about 80. So yeah, if you're looking to borrow into retirement, then they would also want to see some evidence of pension contributions. I mean, that could just be state pension. If they're happy, state pension's enough to cover your mortgage and your lifestyle, that might be enough. But realistically, it probably won't. So that's probably another thing. If you are older and looking for a mortgage, another thing that you can do to prepare yourself is to start making some contributions into a private pension. But again, that's not advice because I'm not a financial advisor. That's looking from a mortgage application point of view. Obviously, speak to a financial advisor who will advise you on different pension products.
That's something that I've not really considered. And being self-employed, I've not looked into pensions actually. Maybe that's my mission for 2024.
There we go.
I was in the military for nearly 15 years, so I have some of a pension.
Yeah.
And I do know that through a limited company, I believe it's tax deductible for your employees, but as a sole trader, I'm not sure it is, but I think the government do match things. Obviously, none of this is financial advice, and I'm just thinking out loud now that a pension is probably something that I need to go away and consider as well. But it's not something I'd thought of for people that may be a little bit older looking to get on the property ladder.
Yeah.
But I do think the average age now, is it not late 20s, early 30s for first time buyers? I don't even
I think it's over 30 off the top of my head. I think it is over 30. So I mean, it's not old, obviously, but when you think about like my parents, they bought their first house literally when they were 18, and the house probably cost maybe double their salary. Whereas now we're looking at probably, I think the average salary in the UK is like about 35,000, something like that. But the average house price is about 350. So it's like 10 times the average salary. Um, so again, without getting into the economics of it just comes back to that. How the hell do we expect first time buyers to get on the property ladder when, they literally have got that to face?
It's a challenge. And I think setting yourself up in the best possible place
Yeah,
is something that's worth starting now. I know you mentioned earlier that people are maybe putting it off because
yeah,
of the current rates. I do know friends that have been kind of waiting
yeah,
and they just got to the stage where there's not much changing. We need to just get
yeah,
on the property ladder
yeah,
now.
yeah,
Um, but the bits of advice that you've given have been great. So initially is the accounting side of it and
yeah,
have the paper trail, maybe separate accounts, just so
yeah,
it's easier to track.
yeah.
And then talking about debts and maybe speak to an advisor and see if it's worth clearing them. I mean, I do have a few credit cards at the minute.
Yeah,
They're 0%, so they're not getting cleared. It's free
yeah,
money. I've
yeah.
paid the
No,
small interest
absolutely.
rate on it
Yeah,
at the
yeah,
beginning.
yeah, yeah,
Um, but yeah, certainly something that I might have to consider depending on what happens in the new year. And then yeah, the types of mortgage and the deposit that you need. I was under the impression, even when I looked at buying years ago, was I need 10%. I'm going to have 10%. And in
yeah.
the end, I didn't. I got quite fortunate. And are the schemes still going now, like the help to buy, that kind of stuff? Are they still options for people?
So the Help to Buy scheme is only available as it was, where you get like an equity loan from the government. That's now only available in Wales, so it's not available in England. Scotland is not available. I'm not sure if they have something similar though. I'd have to double check. But there are other schemes. So there's shared ownership, where you buy a percentage of the property and rent the other percentage. There's very different views on that, whether it's a good thing, whether it's a bad thing. But I just think if that is your only option, it's better than paying 100% rent. At least if the house price goes up by X amount of money, you are going to benefit rather than it just being your landlord that's getting all the money. Another one, again, I had a client recently, is right to buy. So if you live in a council property, and you've lived there over a certain amount of years, then what they will do is offer you a discount on that property. And you could then use that discount. So say, just for easy calculation, say the house is worth 100,000 market value, and you've lived there for 10 years, so maybe, I don't know, you get 20% discount, just for example. So you could buy that property for 80,000. So the £20,000 difference is your deposit. So you don't have to actually put up a cash deposit. I had another client, very similar to that, but this was a private landlord, and obviously private landlords don't have to sell at your discounted rate. But again, you can do, it's called a concessionary purchase, where, so if you go to your landlord, if you've got a good relationship with your landlord, maybe if you haven't, then maybe they want to get rid of you. They might sell it you for slightly less than what the market value is. And again, that can be used as your deposit. So I had a client earlier this year where her landlord had agreed to sell the house for £10,000 less. She did still put a bit of a deposit in, but her deposit plus the discount equated to her whole deposit. Now you can't. That only really applies to like where a landlord's discounting it. If you go and see a house that's worth 200,000 and you say to the vendor, "Oh, I'll give you 180," that's different. it doesn't work the same way. The landlord thing is actually a recognised way of discounting the property. And obviously the lender's still got to be satisfied that the house is worth the 100,000 rather than the 80,000 that you're paying for it.
That makes sense. And there seems to be a few things like that going off at the minute, because I know there is a bit of a push to get people into buying.
Yeah,
And there's been a few things on the news, not so much recently. I think there's other things going on at the moment, but there was around the rental market and how people just can't get rental
yeah,
properties.
yeah,
So it's a challenge all round. And I think, as most of my audience is driving instructors, and
yeah,
for anyone looking to get onto the property ladder, I think some of the advice you've given there has been great advice, because sometimes you don't really know where to start. I know I didn't. It was just like, right, I want to buy a house.
yeah,
I've got a bit of money. What's next?
yeah,
And didn't really, I hadn't prepared for it all that much, because I
yeah,
was fortunate. I was in the military. I was paying next to no rent
yeah,
because I was living on camp. So I think getting all of those things in place and having someone that you can talk to
yeah,
and get advice from, whether that's someone like yourself or a
yeah,
financial advisor, depending on the age, because that's
yeah,
something that I'd not considered, was
yeah.
having a pension, because I don't think a lot of people do. I know a lot of
No, I've
friends
spoke
and
to a lot
family
that
of
don't.
mine don't have a pension.
Yeah.
They're just going to figure it out when they get to that age.
I
And
think we all
much
just
like
think,
me,
oh,
if I
it's
don't pull my
ages
finger
away.
out,
Yeah, it's
yeah.
ages away. It's ages away. The next minute, oh my God, I'm 40 in 2 years. And then it's like, oh my God, you know what I mean? And then it just comes around and bites you. So, but one other thing, just while I remember, because this is, a big help for first time buyers, there is a product called a lifetime ISA. I don't know if you've heard of that. So there used to be another one called a Help to Buy ISA, but that's gone now. But the lifetime ISA works pretty much the same way. There are some terms and conditions like your max age and stuff like that. But basically, the government will give you 25% on top of your contributions. So if you can only put in up to £4,000 in a tax year, but if you put that whole £4,000 in, the government's then going to put £1,000 in, but it can only be used either for purchasing a property or when you get to retirement age. Then you can take it out with the bonus. So worth looking into. Google it, have a look at lifetime ISA. If you are thinking about maybe buying, it's got to be more than 12 months away though, because the lifetime ISA has got to have been active for 12 months. So if you're thinking maybe I'm going to buy, maybe in a year, maybe in 2 years, just open a lifetime ISA and put £1 in it, because then it's active. So then if in a year's time you think, oh yeah, I do want to move, you could then put your full £4,000 in and straight away get the government top up, because it's been active for more than 12 months. So yeah, another bit of advice if you've not already got one and you are thinking about buying, is have a look at a lifetime ISA. It's free money. Why would you not?
So with the ISA, then you've said about the £4,000 you can put into an ISA, and then you get £1,000 back
Yeah,
each year as a
yeah,
bonus. Would that be, so if me and my partner were to go and buy a house now, and let's say we've got £8,000 saved, she could put 4,000 in a ISA, I could, so we could potentially get a £2,000 bonus towards a house.
yeah. So as long as the lifetime ISA has been active for more than 12 months. So if like you think, oh, next month I want to buy a house, let's put this 4,000 into a lifetime ISA. It's not going to work like that. It's got to have been, so your first deposit has got to have been more than 12 months ago. So even if you just put £1 in, that started that countdown of 12 months. So if you've both done that and you both got, you've saved for a year, you got £4,000 in there, then yes, you'll both get £1,000. So rather than having 8,000 that you've actually saved, you're going to be able to get £10,000 deposit. So you're eight plus the government bonus of two, and that's so So it's your solicitor that will deal with that. So they request the fund from the government, the extra £2,000. Just be mindful as well with that is sometimes solicitors charge a little bit more if they've got to deal with a lifetime ISA, but we're only talking maybe £50 more, which if you're getting 2 grand, you don't mind paying £50 to a solicitor to get it.
They've got to get some extra of your free money,
They
haven't
have, yeah, obviously, yeah,
that's some good advice with that as well. I know my partner watches him quite a bit. Is it Martin Lewis?
yeah,
And all of his tips. So he's always banging on about the LISA. And
yeah,
I'm going to look into them a little more because I've not got a pension. I do have a stocks and shares
yeah,
ISA. I'm not sure how they'd work with a LISA. I
yeah,
will do some research on that and potentially look at them for a pension. Maybe
yeah,
speak to a financial advisor
yes,
as well,
I would, yeah,
because the stocks and shares, higher risk, but potentially high reward with the compound
yeah,
effect over the
yeah,
next
yeah,
50 years that I'm going to have to work until retirement age in this country.
yeah,
But we're not going down there tonight. We'll stick with the positives and
yeah,
what people can do to prepare to purchase a house or potentially not worry too much about remortgaging. I think
yeah,
I feel a little more comfortable having spoke to you, knowing that I've got a remortgage coming up and I'm
yeah,
solely self-employed for the last almost 12 months.
yeah,
I'm not as worried, apart from the fact that interest rates are double what I was paying or I'm currently paying.
yeah.
So that's going to be a challenge, but we figure that out and we'll make do. I'll just do more driving lessons and it'll be
Yeah, and I
all
mean,
right.
even with that, so at the minute, this obviously we spoke a lot about how people can prepare to buy the first house, whatever. But for those that have already got the house, like you, and maybe currently you're paying 1%, 2%, whatever, and you know that it's likely yours is going to go up to maybe 4 or 5% next year or whatever. If you can, and this comes down to affordability, because at the end of the day, next year you're going to have to pay it, or you're going to have to sell the house, one way or the other, or extend the term or whatever. Um, but another bit of advice is if, again, check the product that you're on, but if you can, maybe start making overpayments to that amount. So if currently you pay, again, just for easy calculation, if you pay £1,000 at the minute for your mortgage, and next year it's going to go up to £1,500, maybe start trying to pay that £1,500. One, it prepares you for when that does actually come, but also then by the time you get to there, because you've been making overpayments, the actual outstanding balance is going to be a lot less than what it would be if you've just been paying your thousand. Now, another way, because obviously um, when the Bank of England interest rate goes up, or so does, although not as quick as the mortgage interest rates, but savings interests go up. So again, if you think you could get a decent savings account rather than paying it onto your mortgage, put it into a savings account, and then when your mortgage renewal is due, you'll have this chunk of money in a savings account, take it all out, bang it onto your mortgage while you're doing your remortgage. So then again, the capital outstanding is much less. And it's just kind of getting you prepared. None of us want to pay that extra £500 or whatever it is. But at the end of the day, you've got to face it that if you are still in the luxury of a 1 or 2%, when that ends, I'd almost bet my own mortgage that it's going to be higher.
It is a bit of a minefield, I think, with this kind of stuff. I'm always trying to balance whether it's worth investing what I can
Yeah,
with the markets the way they are, because the markets are not great at the moment,
yeah,
which means they're gonna come back eventually. Whether it's in time for my remortgage or not, I don't know. And then with the mortgage repayments, if you're making overpayments on your mortgage, that tends to come straight off the um loan rather than the interest. Is that right? Or
yeah,
does it
yeah.
depend on the product?
No, so it should come off the capital. So then when you get to the remortgage, rather than say owing 120,000 because you've been making overpayments, now you only owe 110,000. So then that will then mean that you're not borrowing as much when you do the remortgage, which then means your payments aren't going to go up as much as if you'd have not made those overpayments. But also because you're making those overpayments, you're also saving interest. because they can't charge you interest if you've paid off that capital. So each time you pay that £500, the next month they're not going to charge you interest on that £500 anymore because you paid it off. So you save interest as well as bringing the capital down.
Interesting. I do need to look into mine, and it's balancing it, isn't it? I'm not, because
Yeah,
I know that if I invest, although it could go up or down, I can take it out next week and
yeah,
I've got the cash.
yeah.
Whereas if I make overpayments on my mortgage,
It's
it's
there.
gone
It's gone.
because
Yeah,
I've got a load of equity in my mortgage now, well, in my house, whatever
yeah,
we call it, but I've got equity there that I can't do anything with.
yeah,
And I think that's where you have the people that are forever renters
yeah,
because they're making their equity work elsewhere. But
yeah,
again, this is all for either a chat with your
yeah,
mates in a pub
yeah,
and hope someone knows what they're
yeah,
doing, or talk to a financial advisor who
yeah,
does know what they're
definitely.
doing
Yeah,
and looking at
definitely.
your financial situation. But
Yeah,
there is certainly some great advice, and hopefully, listeners, viewers that are either looking to remortgage or looking to get on the property ladder can get something out of this, whether that's maybe having a little more structure with the accounts, or whether that's going speaking to someone, although they may not have the deposit that they want.
yeah,
Maybe they can get a mortgage with the funds that they've got. And then for people like myself, looking at the LISA and if that's worth doing for later down the line, a
yeah,
pension,
yeah,
or giving me the nudge to go and speak to someone that can advise on
yeah,
pensions while
yeah,
I'm not young, but I'm not yet worried about retirement. I think
yeah,
a couple more years and I might be. So,
yeah.
yeah, loads of great advice there. But if anyone wants any more advice from you, where's the best place for them to go?
So the best place, obviously, we could probably put my email in the comments or the description of the video or something.
Yeah,
Drop me an email. I've also got a link tree which has got links to other things, so maybe I'll put that on there as well. But yeah, pick up the phone, send me an email, and then we can arrange a chat. Like I say, there's no harm, even if you know you're not ready yet because you've not got any deposit or whatever. It's always worth speaking to me because then, or to any advisor, um, because we can just kind of help you set those goals of where you need to be. Because, like you, if you just said that you thought the deposit would still be 10%. Now, if you were a first-time buyer and didn't really want to pick up the phone to an advisor, you might be there trying your hardest to save up that 10%. Whereas actually, you've already got your 5% and it's been in the bank for the last 2 years, and you could have bought 2 years ago. So yeah, if even if you think you're not ready, just pick up the phone or drop an email. I don't mind if it's a quick question. Hi Andy, I've got a 2% deposit. What do I need to do? I could just send an email. All right, carry on saving, blah blah blah. Or we can have a phone call, whichever you prefer. Some people don't like to talk on the phone, don't like to have that conversation. Um, I particularly find people that have less than perfect credit history sometimes get a little bit embarrassed about it. But trust me, there's absolutely no reason to be embarrassed. We've all made mistakes in our life. We've all made rash decisions and gone and bought something that, a month down the line we regret buying. Um, so just pick up the phone. And like I say, we can have a look and then kind of decide on the best steps to take.
sounds good. We will put all of those links in the description. I'll also, when this goes out, we'll tag your pages that
Yeah,
you've got for
yeah, yeah,
so people can drop you a message, give
yeah.
you a call, find your stuff online. But Andy, it's been great to chat with you
No,
tonight. I've
thank you
really
very much.
appreciated it.
Yeah, yeah,
Lots
no, it's
of
been
great
great.
information there. Thank you very much.
No problem. Thank you.